You often heard this phrase, gold is God's money. Have you thought why we often say this, that gold is God's money? Because gold has played such a massive role in how the money system has evolved over the last 5,000 years. And it's only the last 50 years that gold has not been there as key part of the money system. So earlier it was the metal itself or some derivative of it, and then later it was currency which was backed by gold, and then later on when gold was depegged from the dollar, that is when the fiat currency syndrome came about, and gold still remains a significant portion of reserves in most central bank assets. So why would any central bank hold gold today? Why would they increase their holdings in gold? Is something that you need to ask. I mean, why are they not, for instance, accumulating silver? Why are they not accumulating platinum? Why are they not accumulating, oil fields? Because gold has always played the core asset or the core. There's a thesis called Exter's pyramid, where gold has been the bottom of the pyramid on which everything else is built upon. So if the current fiat system fails, the reserves in the central banks is where, which will be used to remonetize the system, so as to say. So we'll look at how important gold has been, and I've done several videos on gold and its importance in your portfolio. I'll put the links below. Please go through some of them. It really is important that you have an exposure to gold. Um, while most of our households do have exposure to jewelry and all those things, but I think specific investment objective to have investment gold in your portfolio and have proper allocation towards it is very, very important. So let's see, from a stock market point of view, what has been the experience. We've shown enough examples in our past videos over the last 20 years how portfolios which have been, either hedged with gold or have some allocation to gold, how they've performed, how gold in INR performs when Indian market is not doing well. For instance, this is the last 4 odd years of Nifty and Indian gold data. The orange line is the gold bees line for representative purpose, and the black line is the Nifty. You can see whenever Nifty has had a great fall, gold was going up, because gold gives you that insurance in the times of stress, and in other times it matches inflation very well. So when the Nifty is doing well, gold may just go flat or slightly up, but whenever Nifty is going down, you can see here gold will go up. you know Nifty going down, gold going up, Nifty going down, gold going up, down, up. So the relationship is very, very, I would say, established, and you really don't have to think about it twice. Now the other part of the thesis is around central banks. As I was mentioning, you can see this last, since 2008, central banks have started accumulating gold in a very big way. This is the annual, quarterly sort of quarterly gold purchases that are happening. While they were somewhere in the 100 to 200 tons per quarter basis all these years, suddenly since COVID, that has changed, and now in the last few quarters they've done even 400 tons in a quarter. So something is changing in the global system. We may be early to detect that right now, but at some point later in the future, this will play a very significant part in the global monetary system, is what my thesis on this says. Because otherwise, I mean, why would central banks put more of their liquid, whatever assets, currency that they have, into this piece of rock, as they call it? So this is very, very important to understand that gold has a role to play here. In extreme crisis like in 2008, you can see that when 2008 crisis happened, Nifty went down 45-50%. Indian gold was up 61% in that same period. So if you had allocation 10, 20, 30, 40, 30, 35% into gold, you would get saved from that kind of annihilation on your portfolio. So what most people uh, do an analysis of gold versus Nifty, and then they will show over 20 years, Nifty did better than gold, so gold is useless. That is not the way to look at it. The way to look at it is look at your gold allocation as an insurance. What if the market doesn't do well? What if we go into a recession? What if some run on your currency happens? Look at Pakistan, look at Sri Lanka, look at Nepal, look at Bangladesh, look at Turkey, look at Venezuela. I can rattle off 15 countries where has been a run on the currency. While we are very fortunate that we have a very robust system today, but who knows in 5 years, 10 years, what kind of governance, what kind of outlook can there be? So this is safety insurance. I mean, when you buy a car insurance to protect your car, you're not expecting any return from it, but here you're getting even inflation beating returns from that instrument. And whenever your main portfolio is going down, it is giving you a counterbalance. So what can be more beautiful than doing that? Again, COVID crash, Nifty was down 25%, gold was in the same time was up 28%. These are actual data that show you how gold is impacting and giving you a hedge to your system. Now, we also at Weekend Investing, we created a strategy called MI Evergreen, where we combined the top 200 stocks which are high in momentum. We select those 20 stocks and we combine it with a hedge of gold. And the result is that we get the best of both worlds. So, in the last year and a half since we've gone live on this strategy, you can see that the strategy is doing very, very well, because we not only are we getting the best of those 20 momentum stocks out of the top 200, but we are adding that layer of gold which add during the downsides as well as going upsides. So now another way of investing in gold, besides physical, besides mutual funds of gold, besides ETFs of gold, which have had some taxation change. So ETF now is no longer the same taxation as it was earlier. It will be treated like the bond, and you will have basically long term after 3 years. And the way out of investing, if you don't want to do physical for some reason, if you don't want to take that physical risk, is to invest in sovereign gold bonds. Sovereign gold bonds, just to give you a primer, is a bond issued by the government of India. It is guaranteed by the RBI and the government of India, offered by RBI. They say that they have equivalent of physical gold backing that, and I believe them. You can invest up to 4 kgs, so that is a pretty huge chunk that you can invest in and get in, without any liquidity issue. And the best part about sovereign gold bonds is that it offers a 2.5% interest on top of whatever gold returns you will make. So this is, I mean, I've long felt in many discussions that this is a giveaway by the government just to, try to reduce the outgoing forex from the country. But as users of this product, I mean, this is like free money lying there for you. I mean, just imagine if you were to go and invest in physical or in gold bees, whatever returns you may get, of course, that is taxable also. But here you're getting additional 2.5% interest on that. So definitely, over a longer period of time, if gold has offered 11.5% CAGR over the last 30, 40, 50 years, adding 2.5% interest on that really, puts a cherry on the cake. Uh, Again, not getting too deep into comparisons, but gold ETFs have percent of holding charges. Gold mutual funds also have exit loads and expense ratios. SGB's 2.5% additional, which gets credited to you semi-annually, is the most beautiful product that is available. And the best part is that it is tax efficient. If you hold on till the end of the tenure, you will get no capital gains tax. Usually, either you can buy in primary market for 8 years, or you can go to the secondary market and buy. There are all these series which are already existing, and buy them at CMP. Usually, there is not too much liquidity in them, but for retail purposes, I think the liquidity is substantial. If somebody wants to buy in crores, then of course, yes, that liquidity may not be there. But also, let's say a current SGB listed on the NSE, let's say for 2025, already has these redemption windows after 5 years. So 5 years, 6 years, 7 years, you will have redemption windows, and at the end of 8 years, it automatically matures and you get it. So capital gain that I was mentioning, you are exempt from taxation if you hold till maturity, but if you sell, in the middle, then you have to pay short-term or long-term capital gains as would be applicable. And of course, the yearly 2.5% is taxable as per your tax slab. So that is all on the tax front. The main issue that I do want to point out here is that an issue is open. I am not getting any commissions to market this, but I think it's a good product. It's a beautiful product. If you have the mature the investment horizon to wait till the maturity, you must buy in primary market. So the primary market price for this issuance, which closes tomorrow, is 5876. I think the average spot market price outside is little bit above this. And most importantly, all the secondary issuances that are currently trading on the exchanges, there are about maybe somewhere close to maybe 30 or 40 issuances. All of them which were trading at a steep discount to the fair value have now closed that gap. So earlier, what was happening, whenever gold bond new issuance was coming, you would be able to get the secondary market sales at a much lower price. So it was not making sense to buy in the primary, but that has changed, and there is hardly any discount left in the primary. In the secondary market, the market has become savvy. I think we have also done a lot of videos on where those discounts were, and those arbitrage windows have closed in the last couple of years. I myself remember in the last maybe 2 years back, I bought some 2.5 years back. I got something like 30% discount to fair value, and I mean, those were the kind of real bargains that were available. But now those periods are gone. But nevertheless, with the price recently having gone to as high at 6200 or 6300, I think the correction in the gold market is a good point to get in and to make your allocation to gold for your portfolio, so that you can protect your portfolio in the times of distress. See it as insurance, and you'll find a lot of value in this particular engagement with gold. So thank you so much for watching this video. Please do subscribe to the channel. Please do press the like button, the notification bell, and do take a look at all the other gold videos that we have done so far. We'll put the links below, and let us know what your comments are, and we'll see you in the next one. Thanks. Bye. Investments in securities are subject to market risks. Read all related documents carefully before investing.